Hello, everyone. Today we're going to be talking about audit-proofing your tax return. And actually, I see I'm getting pretty much of a glare here. I'm going to have to close my window a little bit. The sun came out a little. Leave a little light come in. Shouldn't be too bad. So I forgot to put up my other light and my other setup here. So we should be pretty good, though. I'll be in the light a little bit. This will be kind of nice. So what we're going to talk about today is audit-proofing your tax return. And we're actually going to use a test return that I put together to show you what I mean by audit-proofing your tax return, the things that jump out that can cause an audit. Now, you'll notice a lot of times you'll see articles. So for example, let me see if I can actually show you this here. My email, I got something from Kiplinger, and I'll share the screen here in a second. Let me see if I can get this up there for you. Okay. So you'll see, 18 red flags, IRS auditors, and if you go through this, you'll see, some of the things. It's just really, one, it's telling you what the red flags are. They're really not telling you how to solve the problem and actually avoid the audit, which, it is possible to avoid audits, and really, maybe not completely, but 90 to 95% of all audits are self-inflicted wounds. So, like this first one here, making a lot of money, or they'll say something like failing to report all taxable income. Well, yeah, I mean, higher than average deductions. If you do, we're going to talk about that. If you run a business, well, of course, those things, large deductions. Actually, we're going to actually look at somebody that is an individual with a sole proprietorship, a small business, and has higher than what you would expect charitable contributions. And the reason why I'm going to focus on those two areas is because they're very common when I see them on tax returns. It's generally where you're going to see an audit coming from. And I'm even going to give you a story of a client that actually deducted a massive amount on Schedule A as a charitable contribution, and why we got it to go through and never had an audit, when I think everybody would agree that it would be almost a no-brainer for the IRS to come along and do that. So let's get right into it. So we're going to have an individual here. I just call them tester. And this is, you're going to notice that there's still some type in here. These forms are still in development at the IRS. We still, even though the IRS said we're going to open on January 28th for doing electronically filed returns for individuals, the truth is that those forms are not yet available in their final form, though I'm suspecting they will be at in the next week or so. But my computer is going to show it this way. It hasn't been updated. And what we do is we just have an individual here that has a small amount of income from business. And I highlighted a couple things with some check marks. So we're going to get back to those because those are very important items. So the things I want to point out, though, is that our individual here is itemizing and has a big charitable contribution. That is going to be the first thing we're going to address. And then the second thing we're going to address is the fact that this individual happens to have a business. I'm saying it's a construction business, Stuff LLC. We're going to see some problems here with 1099s. We're going to see some problems on the returns that we can fix. And then we're going to do one last thing we're going to close up with, which is what I call my coup de grace, if you will, of resolving IRS audit issues before they ever start. So the goal is let's not get into an audit. So the worst thing about taxes, of course, is you got to pay them. But the second worst thing, and maybe even the worst, is that you do the return, you do everything correctly, and you find out at the end of the day they're going to give you a call, they're going to go through your paperwork, and it's just not one of those proctology exams you want to be involved in. There's no value in it. Even if you did nothing wrong, you waste 6 months to 2 years of your life. There's going to be some cost if you have an accountant, and it's going to cause some stress. And at the end of the day, they say, hey, wonderful, you did everything correct. And thank God you didn't lose any receipts. So the goal is never to waste the time. Let's just not have the audit in the first place. So we're going to look at this return here, and I showed you some of these items. And what we're going to do is we're going to go back to 1040, and this is the new 1040. So this is actually page 1, this right here up to here. And then down here is page 2 of the new 1040. Everything else goes on schedules. What you'll notice here is this individual has an adjusted gross income of $22,000. That's going to be important in a second. He did still qualify here, if you can see with the little check mark that I'm doing, the qualified business income deduction. Now, this is a single individual. I kind of did this intentionally. So you can see there actually is some tax there. There is a little bit of income tax. Most of the tax, though, paid here is going to come in this area right here, which is self-employment tax, which comes on another schedule over here on 4. And he did not have any health care. So I actually went and just to let the computer calculate that for me. I just didn't do all that detail in the background. So just assuming some of the things. Oh, by the way, I still think I'm humorous. His occupation is bum. So here's our guy. He's making 20,000 something a year, and from all intents and purposes right here, we don't have a problem with the return. He has some income. He's not getting an earned income credit, so we don't really see any problems here. But as soon as you dig down a little bit, the first thing we're going to run into is Schedule A. Excuse me. Now, Schedule A is going to be one of them things that there's not much left on it anymore. I'm assuming he had no mortgage interest. I assume he didn't have any state and local taxes. There's a little bit here for sales tax because I didn't put anything in. But the truth is, at the end of the day, what I did is gave a big number so that he could put it on the return and make it show up in this number. Now, his income, if you go back to 1040 here, his adjusted gross income, is $22,024. You can only deduct charitable contributions on Schedule A up to 60% of your AGI. So you go back over here, and that's what you're seeing here. You're seeing $13,214. But he actually gave $47,500. It's more than his actual income for the year, and we're going to address that. What we're going to do to solve that. Now, the reason I bring this up is I had a client that has been with me for many, many years. He inherited some money, and he's in Scientology, and whether you like it or not, it still is a charitable organization. He gave a lot of money. He gave more than his income for the year. So we had a big number like this up here. We had a smaller number down here because it wasn't all allowed the first year, so it's carrying over. And we never got audited because I did something that was a little bit unique. Whenever you see a big number like this, and it's going to stand out. I mean, if there's anything to audit, that's what you're going to audit, right? We actually go and we tell the IRS with Form 8275, we actually go in and tell the IRS, hey, charitable contributions, we have a big number there. And we inherited property when mom died last year and decided to donate a large part to charity. See attached documentation. What I did for my client that was in Scientology, I took all the deductible receipts that he had, I scanned them in, and let me make sure I want to make sure I can see all my comments down here if anybody's commenting. So this client of mine donated well over 100% of his income. We had to carry it over for a number of years. And I attached actually scanned documentation. Now I'm going to show you what my tax return does here so you can actually see it. Now I can actually go in here and see if you can, and I'm going to go slow enough. In fact, I wonder if you can, let me do this. There we go. And so you'll see down here this PDF thing down here, if you can see it. I can actually go in there and attach a PDF. So I'll just scan in documentation that if I know the IRS is going to look at this, if I know their computer is going to spit something out, what I'm going to go ahead and do is I'm going to intentionally scan this in and attach it to the return and tell the IRS, this is what I did. Here's my proof. Now, the reason for that is this. One, they can audit the return and you'll never know it. That's the great part. That kind of audit I don't care about. I proved my case. I provided documentation. If they're going to look anyway, at least give them the stuff up front so they don't open the rest of the return. That technically didn't audit-proof the return completely, but it certainly made your life a lot easier. You never even knew you got audited, and the IRS knows the accountant or you did all the work necessary to verify the deduction, and they have the proof in place. This is not low-hanging fruit. They don't have the resources to be chasing you, so you need to have something else in your life that you've done a little bit different. On your tax return, that would be an issue. Now, this is a little bit different for most people. So this is a professional grade software program. You can actually use the tax software that I use, and I can include that link. I didn't include that link right away. I'll do that at the end of this. It's not going to look exactly the same as any of the over-the-counter, the online tax software. So what I would do in these cases, though, is you just have to have a description and you have to have a name. It has to be a PDF file. So in this case, I would probably just call it charity.pdf. And then my description would be contributions to charity. And what I would do then is I would then go ahead when I calculate my return, it actually gives me the option to then attach things up here. If you see on top up here on the screen, I can attach a PDF here, and it'll actually let me go in and do that wherever I saved it. Now, and you'll see I have some error messages in here, but that's just because I didn't complete the return and I used the fake EIN or a social security number in that. But that is a way I always use as an accountant. I can reduce my audit rate 90 to 95%. In fact, I haven't had an audit in my office in probably the last 3, 4, 5 years that I didn't bring in from off the street, or the client goes, oops, I forgot to give you this, and we get a letter, which is still considered an audit. It's a correspondence audit. I don't have audits with these snarly things that we don't want to deal with. I don't want to deal with these issues if I don't have to. The best way to deal with it is during tax time. I know I'm doing it correctly. I'm going to attach the thing, get it out of the way. I'm going to disclose everything, and I'm going to avoid all the headaches of having to deal with this, in 6 months, a year and a half, 2 years down the road, and then I got to pull up all my files. You're going to be stressed out. It's going to cost you some money. You don't want that, and I don't want it either. So that's the first thing when it comes to Schedule A. Before we move on to Schedule C, I do want to make sure that I want you to understand this is not an all-inclusive thing. There are so many issues that can come up on a tax return. I use this Form 8275 quite often. Now, you'll see a thing here where it says revenue procedure rulings or the group items, things like that. That is if I'm taking a position based on tax law. So if let's say, for example, I have a gray area for a deduction, then I'm going to go ahead and put the tax code or the revenue ruling, the RevProc ruling. Maybe there's a tax court case or something. I'm going to tell the IRS what I did and why. And again, it's not low-hanging fruit anymore. And if it's not low-hanging fruit, they're probably going to leave you alone, which is what I'd rather have that. I just prefer they leave me alone. Now, here's a very common tax return that I'm going to see. Somebody has a small business. So I have guys that do drywalling and they do some small, maybe they're general contractors. Maybe they're going to be laying concrete, roofing, siding. I have a fair amount of these guys doing the construction industry. Some of them end up on Schedule C, usually in a case like this, because the income is under $30,000. I wouldn't even consider turning him into an S Corp yet, even though he is probably going to be an LLC, as we can see here. Schedule C, by the way, is the absolute worst form for getting audited. This form is going to get you audited more often than anything else, and you have to take special care when you're preparing a sole proprietor return to make sure that you don't end up having these things bounce back. About 4% of them, I believe, get audited, so 1 in every 25. So first of all, there is no earned income credit on this return, so that does help, because this would kind of fall into a sweet spot if there was children involved in an earned income credit. But the first thing we're going to look at is you have to answer some questions up on top, and these you have to answer correctly. First of all, you're going to notice that it says here on line I, did you make payments in 2018 that would require you to file Forms 1099? And I checked no. And I put a checkbox here as my reference here. because I want you to notice that if we go down a little bit here, we can see this right here, this red flag. We have contract labor of $62,330. If all these people that you have as subcontractors have their own business, issued an insurance waiver, I mean, so for workers' comp, things like that, then the answer is yes, you may have no 1099s. If that were the case, I would actually do a disclosure pointing out to the IRS, by the way, there's no 1099s on this client's tax return. They have a Schedule E. They got $62,330 of contract labor. And they didn't send out 1099s because we have waivers from every one of these contractors and it wasn't required. Or if they're actual corporations too. So if my business is an actual corporation, if an LLC is treated as an S corporation or a regular corp, you still got to issue those 1099s. So I'm going to disclose that. So we're going to change the answer here to this situation with this client. We're going to say that he actually did have 1099s and that he did actually send them. Because if we didn't, we're going to need to disclose why we didn't, because otherwise it's going to be an audit risk. So back to our Schedule C again, we now know that this is all answered correctly, and we know that this is okay. Another big item is advertising. I don't think it's extraordinarily high. I probably wouldn't do anything with this, but whenever I review a return, so the first thing I do when I prepare a return, I plug all the numbers and get an accurate return. That's what I want, accuracy first. Then I look at the return and decide, can I do things to optimize that return to make it more tax efficient? And then the last thing I do is there anything in this return that makes it look a little dicey, that it might be more auditable, that there's something to look at? And my answer is, when I do these things, is big numbers jump out. So we have some truck expense. When I started out my example, I started out with a smaller truck expense, but he's in construction. So I'm going to be surprised if I didn't see a larger truck expense. That's what you're going to do. Advertising at 17.9 isn't extraordinarily high, but it would jump out. The contract labor, as we discussed, I would be looking at exactly what I did. Then there's going to be some miscellaneous. I knew there'd be about 4,000 here. There's no depreciation. That's fine. Things may have been deducted originally. And insurance, I would expect to see that, some legal and professional, some office expense. There's some rent of some machinery. Okay, there's no depreciation, so he's renting equipment. But the big thing that's going to jump out for me is this item right here, supplies. $119,664 of supplies is about a third, actually more than a third. It's almost half of the actual revenue. That is going to be problematic. Supplies, in my mind, end up being things that are not a cost of goods sold. So in my office, paper is a supply, an office supply in this case. But if you're in construction, maybe some nails and some caulking or things like that are going to be supplies. Most of these items here don't belong there. They belong someplace else, because if I have $119,000 of supplies, I'm going to be disclosing that. That is really going to jump out for the IRS, and I'm going to want to disclose what exactly I did and why this is a deduction. In reality, this number right here really needs to be addressed and put down here as a cost of goods sold. And I'm going to show you how to do that in a second. And then I have some tools that are under $2,500. And I'm going to show you why that's important in a moment as well. What we're going to do here is we're going to make the assumption, and we're going to do some easy math here, because we're going to say we got $119,664. We're going to assume that $100,000 of that is cost of goods sold. So this is going to be, the wood and concrete or whatever it is to do the actual work. It's a cost of goods sold. When you're in construction, the IRS knows there's going to be a big cost of goods sold number. It's just normal. And then over here you have $19,664. And to be quite honest, I still consider that rather high. I would probably see if there's anything in there that I can move over to this area as cost of goods sold, and I'll show you how that looks on the tax return. And what's going to happen here is we're going to take this number here for supplies, make it lower. If there's anything I can get there, so if you're buying nails and it's just not for a project, then okay, maybe it's not a cost of goods sold. Maybe it is a supply. Maybe, tape measure or something like that. Maybe maybe use tape for multiple jobs or something. Down here is where we're going to have our cost of goods sold. This is going to be the purchases, less things out for personal use. And in most businesses, there won't be too much for personal use. So you have purchases of 100,000. There's no inventory. You buy what you need for the project. That ends up going up here. So income is revenue is 264,000. We have cost of goods sold here of $100,000. That's going to give us our gross profit of 164,000, and then everything else looks pretty good in place here. Again, this number I would try to do something with. I would not probably disclose on the 8275 this number in this tax return. I don't think it's significant enough. I think the only issue I would do on this return is I would disclose in that Schedule A item. But we do have the issue here of these tools for $2,267. What I do with that and how I fix that is there's an actual election in here. So you'll see that there's a safe harbor election. And what this means is that anything that is under $2,500, you can make an election and say, I'm just going to deduct it. So I buy some tools. Maybe I buy, let's say it's one tool, $2,200. 10 years ago, you would be depreciating that over 5 or 7 years. Today, we can go ahead and make this election, check the box, and just write it off. Now, if you buy 10 tools that are under $2,500 each, you can deduct all 10 of them. How you do that is in your tax return. And again, each one of these are a little bit different, each program. But this right here, you're going to see this election box. There's going to be an election screen on your tax program someplace. And what you're going to see right here, if you can see my cursor going around, I have a checkbox under taxpayer. And if you look over to the edge here, it says section 1.263A1F, de minimis election. That is what that election is. It's the most important election that, in my opinion, any tax return that is a business, such as a C Corp, S Corp, partnership, automatically does the election. I don't care if you think you're using it or not, because the election must be made on a timely filed original return, which means if you go into audit and say, oops, I made a mistake, I didn't realize I had an item, the IRS auditor is going to assess the tax. You cannot deduct it. You must depreciate it. And if you're depreciating it, you don't get the break, so you end up with a tax bill. You can't fix it because it's not the original timely filed return. If you check the box and do the election and you don't need it, well, it doesn't hurt anything. So on individual returns, any individual that has a rental property, even one, any personal income tax return that has a Schedule C or a Schedule F, I will automatically, by default, check that box. If it's a married couple, both of them, even if only one is using it. And the reason for that is I do not want to get into an audit, if there ever would be one, and I really lose the ability to take deductions should we even find a receipt. So the client might say, oh, I have an extra receipt here. I forgot to give this to you. I can't even deduct it and offset and force the IRS to give you a refund because I can only depreciate it. I didn't make the election. So this is a very important point as well too. If you have $10,000 or $20,000 in tools, I wouldn't consider that unusual in a case like this with a construction company. So I wouldn't disclose that in an 8275. But what I will do is I will check the box for the de minimis election. If it gets to be extraordinarily large, let's say you have a lot of items under $2,500, there's two ways that you can handle that. One, you can go to that 8275 and you can disclose the information in there on a screen. Or what you can do as well is you can list it here on the return separately. So you can go in that list that says, section 1.263A1F, de minimis election. I would write that in here. I would put the letter S 1.263 election, and then the item, tools, table saw, and I would list each one of them separately being under $2,500. That is a way of disclosing, and the IRS knows what that is. An auditor pulls up the file if it would ever trigger, and the great news is you wouldn't have to worry about an audit because it's pretty much self-audited. It's done already. The last thing we're going to touch on, because we're not going to go too long today. We got about 25 minutes already, so we don't want to go too much longer. There is one other item where you can take a big deduction, and if you can see this here, this is the depreciation form. What this is here is if you have a rental property or an office building, like I have my office building here, and if I'm doing a repair, for example, carpets out, carpets in, it's deductible regardless. If it's roof shingles off, roof shingles on, it's deductible regardless of the cost. It is not an improvement. It is a repair to bring the building up to its original value. But let's say, for example, you have a rental property and you're going to renovate a kitchen or you're going to renovate a bathroom. And if the cost is $10,000 or less, you can elect to choose to either deduct all of that $10,000 as a repair, up to $10,000, or you can allow it to be treated as it normally would, which would be capitalized and depreciated over basically 27 and a half years for a residential rental property and commercial for 39 years. Now, if you can see my form here, if you have, I'm just going to put down stuff, and we're going to say we acquired it 10/1 of last year. Cost is going to be $9,800. Actually, let's call this a remodel. Let's say that our client here had a business and he wanted to remodel, maybe a leasehold improvement, so to speak. So it's less than $10,000. What he can do is he can check this little box here, and I think all the software online is the same with this. Building qualifies for Section 1.263A, 3F, or 3H election. What you do with this, and I think most software is the same. I know how mine works, and that is you would put into class life. So this is going to be a commercial building, 39 straight line, and it's going to be for 39 years. And you take the $9,800 out of here, and you just drop it into repairs over here. You do not need to do an 8275 disclosure when you do this. And the reason why is the IRS already knows that you made the election. So I'll show you what this is going to show up here. So you're going to see the elections here. You're going to have our de minimis election. Where are they going to hide the other election on me now this year? I check the box, make sure I check the box for the election. There's going to be an actual separate page for this. Oh, I see, C1. Okay. So we're gonna have an election. It gets attached to the return automatically. There you go. So here's the safe harbor election for de minimis, and the election right above it is going to call it our remodel down here. And what that is telling the IRS is this is going to be treated as a repair or maintenance. And what we're going to do is deduct it right up here in Schedule C. Keep in mind that's going to have other effects on the tax return. In a case where your income taxes are this low, I may choose not to do that. For one thing, your Schedule A itemized deductions will be lower as well because your AGI is going to come down. Your QBI deduction will come down. By the way, this guy got that as well. In fact, what I'm going to do is go back in here and delete this, since I hope you guys can go back and look at this more than once. And then we're going to wrap this up unless there's any questions. So I see there's a couple of people on here. If there's any, I'm not showing any questions on mine, so I hope it's not something on my end that I'm not seeing anything in the comments. This individual did qualify for the qualified business income deduction, okay, right here, $183. And where that, well, actually some of the, oh, I'm sorry, I didn't take something out. I knew it was higher before. This $9,800 comes out then because we didn't do we just used that as an example. So what we would do then is we would have to decide, what do we want to do? Do we want to deduct this currently as a repair, or do we want to expense it or do we want to capitalize it and depreciate it over a number of years? Well, the QBI deduction right here, as you can see, is $1,678. Well, if you take it, it goes down to like $173, $163, some lower number. It might not make sense to do that. Even though you can do something, doesn't mean you should. And even though it might lower your taxes, you don't necessarily always want to do that, because when you consider all future years, that can be very problematic. So this individual now has audit-proofed his return. He's kind of maximized it out. So if he would have had a $9,800 expense, I would have probably capitalized this and depreciated it over 39 years, mostly because his income tax right here, as you can see, is extraordinarily low. And his qualified business income deduction is $1,500 higher. And I don't really see a lot of value. There is some self-employment tax there. That is true. His taxes would be somewhat lower, but we end up wasting some of that deduction anyway, and I really hate that. So when we see Schedule A, everything that's the difference. So we got 47,500, we got 13,214 minus, so there'd be 34,286 carried over. One more thing I'm going to show you as well. That line that I showed you for the qualified business income deduction is just one line on page 2 of 1040. That's all you get. You don't get any more than that. But there is a worksheet the computer figures out for you. Now, what I did not do in here is I did not check a box. So when you have, in fact, let me show you this as well too, quick guys. So if you have a rental property, you'll see down here in this corner where it says this activity is a trade or business. I have a previous Facebook Live video where I talk about this. If the property is a rental property, it's almost certainly going to be yes as a trade or a business, unless it's an investment that you're not renting out, in which case it's an investment, not actually a trade or business. If it's a rental property where you're renting out something, I think it is going to be a trade or business. Where it's really, really sketchy is, let's say you rent out one room in your house. I would argue it's still a trade or business, but there's some clarification the IRS needs to do. But you need to be aware that this exists here, and that you need to list that. And for here, you'll see a box right here. And if you can see this, excuse me, I'm going to have this little check box here. And if you can see me clicking it, what that is that's a specified service business. Now, if this were my business as an accountant, I have to check the box. So if I go ahead here and click this, and maybe my computer will pop this up. See, it's going to show you, most computer software will show you what those things are. So health, law, accounting, oh, that's me. We're one of these specified service businesses. If your income gets to be a little bit higher, it gets to be problematic. You just lose the deduction, that qualified business income deduction. So that's something to be aware of. You don't need to disclose that other than checking the box. You don't have to disclose things where you make elections, because that election is the disclosure. So in a return like this, probably this one item here inherited a lot of money, very similar to my client. The worksheets here, I was going to see if there's so many things end up on worksheets this year now. So there's state and local taxes. By the way, here's your election. So this is your deduction limits for and the carryover for, here's that 34,286. That's how much of your charitable contribution is going to carry forward into the following year on this example. So I'm going to give a few seconds here. If somebody has any questions, if they have something that they would like me to discuss, I'd be more than happy to do that. Quick before we wrap it up, I'm going to add this little guy here so people see it as they come in. Oh, I see how that bumps up. See, I have a really little screen on the side that shows me this, and then it's even a smaller screen yet. So it's maybe literally that size of my fingers there. So I have to squint to see that as I'm working with dual screens. If you have any things that you would maybe be concerned about with your taxes or somebody else's, or you're working on something, I know other accountants contact me on this kind of stuff and ask why I have so few audits. This is why. I audit-proof every single tax return. The last thing I do with the return, once I prepare it, I review it for optimization, and then I look at that return with a jaundiced eye as if I were an auditor that has an attitude, okay? like right now, and as this is being recorded, we have a government shutdown. They're not getting paid if they're even on call at all. My response to that is, they have a bad attitude maybe. So if I was an auditor with a bad attitude, what would I see in this tax return? And I address those issues so that no matter if it's a good auditor, bad auditor, doesn't make any difference. I just don't want them sending me or you a letter because I just don't want to deal with it. Neither do you. So I see. Thank you for the session. When will it be posted? This is. I think as soon as I turn it off, I think it goes up. I'm going to add a link to my do-it-yourself program, which is really using my software. This goes, as soon as it's done, it's immediately startable again. You can start from section 1, and you can stop and blow it up and things like that. And that's why I kind of go through this a little more quickly, because I know that you can go back, review it, stop at those things, expand your screen, and look at that kind of stuff. If I spend too much time, then we can kind of get bogged down. So Carlene was thanking me, so is Kristen. I thank you guys for stopping by. As always, you can always give me a jingle or a shout out in the Facebook business page, as well as the group. There's a Wealthy Accountant group page. You should belong to that. You can ask questions there that don't end up showing up on your timeline for friends and family to see, so it can be a little more personal, and which is kind of nice. And if anything else, just let me know. I think I'm going to have another one deducting employee expenses. I'm not sure if I'm going to do that next week, but I think so. Will be the next live event. If you have any audit concerns on a return, throw it in the Facebook group, because that'll be a little more private. Thank you as always for these videos, John. Excellent. So, okay, I'm going to call it quits. I don't have to have too much of an exit here. So you guys have a great day. Have a great tax season. If you're a tax preparer, if you're not, hopefully they open up and get you your refund as quick as possible. Use these things to reduce your taxes too. Don't always look for the lowest tax this year, but make sure you consider all years. So don't try to waste things by accelerating some expenses. You can choose not to deduct under those. Remember that $2,500 thing? You don't always have to do it. In some cases, I don't do it. And the reason why I don't do it is because they're maybe in a 0% tax bracket or very low tax bracket. I will not throw that away. Then I will go ahead and capitalize and depreciate for a number of years, where at least in the future, if there's a taxable liability, I can use it then to reduce the tax bill. So with that, we'll call her quits here, guys, for today. You have a great one. Have a great Wednesday today. And for anybody looking at this later, have a great time. I'm going to add that link in a second. There's 2 blog posts I put in there that I wrote a while back that expand on this a little bit, especially if you have things like an S Corp, things like that. But you guys have a great day. Thanks for stopping by.